afternoon, and welcome to our Glendale City Council workshop. This meeting is for council members to review and discuss important issues, projects, and future council meeting agenda items. It's a work-study session only and allows the council to hear input from city staff. No action will be taken at this workshop, and there will not be an opportunity for public comment. This meeting is streaming live on Glendale's Facebook and YouTube pages and the city's cable television station, Glendale Channel 11. Thank you for joining us.
Good afternoon. Welcome to Glendale City Council Workshop Session of October 11th, 2022. The meeting is called to order. I see one council member is missing, so we'll go ahead and do an attendance roll call in hopes that he'll get here before we get to him. Councilmember Clark, are you present?
Here.
Councilmember Hugh? Here. Councilmember Tomachok?
Here.
Councilmember Turner? Here. You want to do it again? Your microphone.
Just trying to run out the clock.
I know.
Here.
And Vice Mayor?
Present.
Okay, and I'm also present, so we'll give him a few seconds. He'll probably be here, but as of that, we do have a quorum. So, Ms. Bauer, would you introduce item 1?
Presentation on the city's investment portfolio.
Good afternoon, Mayor, members of the council. Here to provide our conversation presentation today on this agenda item is Levi Gibson. He's our interim budget and finance director. Levi.
Thank you. Good afternoon, Mayor and Council. Today we'll be doing our annual portfolio review, which is our promise to come back to you each year and update you on the city's investments. Our presentation today, we will go over first the Arizona state statute that governs the investments that the city is allowed to invest in. Next, we'll have our special presenter, Ash Mehta, with Public Investment Advisors, give you a market update and a portfolio review. Investment of public monies is governed by Arizona Revised Statute 35-323, and this statute allows us to invest in different types of investments. The statute defines the eligible investments and sets the maximal maturity at 5 years. Some of those investments that we're allowed to invest in based on U.S. Treasury obligations, federal agency and instrumentality securities, and you can think of these as Fannie Mae, Freddie Mac, those government-sponsored entities that the federal government has sponsored, corporate bonds, prime commercial paper, and interest-bearing savings accounts, or CDs. With that, I'll turn over the presentation to Megan Elgin, our controller.
Our investment policy, our objectives presented in order of priority up here are our safety, to keep public money safe, the liquidity of when funds are available to use, to diversification, and then lastly, for yield. Our investment strategy, we have 2 portfolios. One is a liquidity portfolio, which is focused on short term, which is for investments under a year, and this allows us to have greater liquidity. And also to manage to meet our cash flows while also maximizing short-term returns. Our other portfolio is our core portfolio, and that is for investing up to 5 years, so a longer term. Okay. And it is managed by public trust advisors to a benchmark following the city investment policy. And with that, I will turn it over to Mr. Mehta to give us our market update.
Thank you, Mr. Mayor. Thank you, members of council. My name is Ash Mehta. I work with Public Trust Advisors as the advisor on your account here. We have partnered with the city since 2015. We've been working with you for quite some time. We have created 2 separate investment portfolios, one for liquidity, again, and one for core for longer term dollars. This is presented to you guys on a quarterly basis to the finance department as well as to you guys on an annual basis. And I'm going to kind of jump in, and Levi, we can jump into the market update. Initially, I'm going to talk a little bit about what's going on in the market, and then we're going to talk about how the portfolios are structured for the next couple of years. So 3 major macroeconomic themes, and granted, this is about this is from June 30th, so there's been a little bit of changes since June 30th, obviously, but the themes are fairly the same, right? Inflation is rampant, it's running out of control. The only way to really control that is for the Federal Reserve to raise interest rates to quell spending, try to incentivize savings amongst consumers, and you know, the other third overlying thing is the recession potentially in the next year. At this point, rates have gone from 0 this year all the way up to 0.25 currently, and are potentially going another 125 basis points before the end of the year. So that'll leave us at a Fed funds rate of 4.5% in December. That is the largest gain within 1 year in the history since 1987. So, we had 0 interest rates from 2008 to 2016. They started going up for about 2 years, and then pandemic happened, so rates went to 0. The portfolio was positioned with a little bit of a longer duration when the market initially went to 0, so we were able to hold the securities that we had invested in to maturity. During 2020, late 2020, early 2021, we had to reinvest some of the dollars that were no longer at the rates that we had them at. They are at lower rates as of now. However, as rates are increasing and as the portfolio turns over, we will be seeing better opportunities with higher yields for these dollars to be reinvested. So the first bullet point, inflation, as we can see here, this is a chart of inflation from August of 2016 all the way to current. There's 3 lines on the screen. The top line, the dark one, is CPI as it's measured to affect the common person, I would say. The gray bar is how the Federal Reserve calculates inflation, that is net of consumer goods and gas, energy, et cetera. Basically what we're seeing is, as of April 2021, inflation went rampant due to stimulus, excess cash, excess dollars in the market, and not a lot of supply to buy. So as economics pertains, prices go up because there's so much demand for goods that are not available. The Fed is trying to curtail that amount of cash that's available by increasing interest rates, making it more attractive to keep that money in savings rather than spending. What this chart's really important is telling us is that inflation is 6% per year higher than their target goal of 2%. So it's not going to be anytime soon, as we can see from this chart, that these are going to turn back down and get smoother. But hopefully with the rates increasing as they have been, this will stop consumer spending, remove some of the cash from the market, and cause that demand to decrease, which will cause prices to decrease, which in turn causes inflation to decrease. We'll go to the next slide. The other interesting thing about this chart here, this is the Federal Reserve economic forecast on the going from December of 2017 and being forecast out for 2 years. Obviously, everyone knows what happened in 2020. The pandemic hit, the economy basically halted, and that's where you saw that drop of 3.4% of GDP. Obviously, 2021, everything somewhat reopened, plus with the stimulus, GDP numbers jumped right back up to a record 5.7%. We saw and have been predicting a lower, anywhere from 1.1 to 1.9%. The Fed says about 1.7 for the next 3 years, which means stable but not excessive growth to recover from the last couple of years of quite a bit of turbulence. Go to the next slide. This slide is very interesting because I'll touch base on this. This is the real domestic product chart. This talks about the output created by the U.S. economy. It goes back from 2019 all the way to predicted 2022 of where we were just about 2 quarters ago. It's not, the color doesn't really reflect very well on this, but if you can see on the chart, you can see the different pieces of what was contributing to those performances with GDP. And as you can see, 2021 was quite a rebound. We had positive GDP, even after the massive 33% GDP growth that we had for the third quarter of 2020. Now, going forward, and these numbers can all be revised up to 6 months later, so we did print 2 negative GDP numbers, but that could be corrected as this data comes out appropriately. And the next slide we have is the investments. So we're going to talk a little bit about the portfolios, and as Megan had kind of talked about, the focus of what we do as advisors to the government entities is safety is number one. You cannot lose public taxpayer dollars. You cannot take a loss on your investment portfolios. That is our number one priority. Liquidity is our second priority, and that is to make sure that if there is cash required, we are able to provide you with that cash without hindering the portfolio. Thirdly is yield. Yield is the last of the 3 tenets for public funds investing. public trust advisors, we like to lay over compliance and transparency. We want to make sure your team knows exactly what we're doing and make sure that everyone is under the same agreement that we're investing the way we're investing, why we're investing. So the next this is going to be the, this is all the funds for the city right now as of June 30th, 2022. As you can see, you're invested in about 66% government securities between both portfolios. 12%, 13%, and 12 and 13% respectively in corporate and government-sponsored entities, and we have about 8% as of June 30th. Those dollars have been reinvested, but as things mature, they flow into cash until we reinvest those dollars out the curve. So as of June 30th, 2021, the entire portfolio was about $192 million. As of June 30th this year, with the addition of an additional $90 million that you guys had excess liquidity that was being held in banks that was earning $0, we were able to invest that between the two portfolios, bringing your entire portfolio to $280 million approximately. On the next slide, we have the breakdown between the two portfolios. As you can see, in the 0 to 1, the 1-year strategy, which is what we call the liquidity portfolio, we have about $101 million that mature on a monthly basis in that account. In the core portfolio, we have $177 million that's invested in a 0 to 5 strategy. That is, as you can see on the maturity distribution chart that is next to that, is where we've laddered the investments out. The one important thing that I'd like to show on this chart is if you look at that 0 to 3 months to about 1 to 2 years, that's about 60% of your portfolio. So the nice thing about the positioning of the portfolio is as those maturities take place, we are reinvesting at those higher interest rates that are being offered by the Fed and corporate papers as well. So we're looking at reinvesting those north of 3.5%, 4% compared to what you guys have been getting during the last 2 years of economic crisis, which was closer to about 30 basis points, so 0.3%. So we're going to get 10 to 12%, 10 to 12 times more interest income over the next couple of years, assuming the projections, et cetera, stay as they are. We're going to break down the next portfolio, which is just the liquidity portfolio. This is, again, that 0 to 1 year strategy, very short term, designed to meet the cash flows, any obligations that the finance department will find. We work, with them quarterly to figure out what money can be reinvested and what money needs to be taken out. Over the last couple of years, obviously, everything's been kind of on hold and potentially have been accumulating, assuming those, these portfolios will start to potentially dwindle down as you start spending on some of these capital projects that you have these funds earmarked for and as kind of construction begins. We'll go to the next slide. All right. And again, this is that 0 to 12 months. You see, 30% of it is liquid within the next 3 months, and the securities are laddered out throughout the year to just provide monthly liquidity and then also some yield on top of that. And that is $101 million. The next slide is, this is the core portfolio. This is, again, that 0 to 5 year strategy, longer term dollars that are designed to not be spent within the next year. We moved it from $115 million up to about $185 million over the year because of ARPA funds, as well as some other dollars that came in from outside sources that had been earmarked not to be spent within the next year. The portfolio is positioned very well, very similarly to the liquidity portfolio in asset allocation, which is 66% government, 16% corporate and government-sponsored entities, and then a little bit of cash as well. The difference between, next slide, Levi, please, thank you. The difference between, obviously, the prior portfolio, the liquidity portfolio, and the core portfolio is the maturity schedule. Obviously, these are 0 to 5 year dollars, so very little is going to mature within the first 2 years. It's typically back-end laddered. So as this portfolio does what it's supposed to do, things will mature, and whether the finance department finds a need for them or if the budget requires that those dollars would go back into the liquidity and then be spent down. If not, we reinvest them into the strategy as well. I think we do, wanted to reiterate, we do buy corporate bonds for the city. We have a very, very rigorous credit reporting research process, and we're happy to talk to anybody about that going forward. We have a credit desk internally that rates all of our securities that we buy. We have our own list of investments that we do not take any outside influence on, so want you to know that we are very much aware of what we're investing in for you and how they do on a very active basis. So going forward, we are going to continue providing regular updates, the outlook to the economy. I work quite frequently with Levi and Megan on cash flows. I don't think there's any need right now to change the benchmark for the strategy. Everything is going to be continually managed to the needs of the city. Obviously, the liquidity ladder will also be managed to the needs of the city, and we do a portfolio review every 6 months with the finance team. That is the end of my presentation. If there's any questions, I'll be happy to take them.
Thank you, Mayor. Thank you. I guess it's a good news, bad news thing. It's a bad time to be borrowing money, but it's a good time to be investing. So it's always, I guess, one or the other. Which brings me to my question, do we have a lot of, because we have a lot of short-term investments, are we going to be able to take advantage of some of these better rates?
About half of your portfolio will be maturing in the next 2 years. So rates are expected to continue to be increasing for the next 2 years as inflation continues to persist. So as the maturities of the securities that we hold now turn into cash, we'll be able to reinvest at higher rates.
Okay, thank you.
Right now, if we were to reinvest, a year ago we were getting 0.3, 0.4%. Now we're getting 3.6%. So again, it's a 10 times, almost 10 times.
Mayor, if I could, on these amounts of money is significant.
Will be very significant.
Thank you.
Thank you, Mayor. These are dumb questions because I don't know anything about what you all do. You talked about the 5-year, the long-term portfolio. Is there any way, and I know it's based on maturity, is when you sell them and you pick up new stuff and get a higher rate. But is there any way to transfer anything from the 5-year portfolio into the short-term portfolio, get the higher interest rate, and then bump it back into the long-term? I mean, I'd like to see the long-term portfolio take advantage of increasing interest rates as well as the short-term portfolio. So that's my dumb question. Now you can figure out how to answer it.
It is possible. It does require, you would have to take a loss on the securities you're currently holding to reinvest them, because that's the trade-off. These are invested at the time because, during prudent reasons, we invested those dollars out 5 years. No one knew that rates were going to go up 3% in 1 year. We figured that it would be a little bit smoother than that in 2020. 2022. No one knew when the rates were going to go back up. We didn't know if it was going to be a 6-year pandemic, a 2-year pandemic, a 1-year pandemic. So now, as the Fed is trying to, curtail all this excess capital in the market, it is a good time for us to put money back into work. But we had already invested it. So as those maturities take place, they will be reinvested. But right now, unless we do want to take a loss on the securities that are crashing, it is an option that is out there. It's just typically not one that is.
Well, let me ask one follow-up question. Would the losses sustained be offset by any gains to be realized by
potentially over a period of time, but it would take a period of time for those gains to overcome the loss.
When you say a period of time, are we talking a year, 5 years?
I can do an analysis. We can do an analysis on that.
I'm just curious as to whether there's any advantage.
Well, so the duration of the portfolio is about 2.5 years, so it would take about 2.5 years before we would get back to even, basically.
Okay, thank you.
Thank you, Mayor. Mr. Maida, thank you for the presentation. On slide 18, just something that piques my curiosity. In the June 30, 2022 column, we have a unrealized loss of over $8 million.
Yes. So
explain, please.
As securities react to pricing in the market, as the yields go up, right, for that same security to yield the equivalent of what a new security is yielding, the price would have to drop. So that is a market. So if we were to go out and sell those securities right now, we would take a loss of about $8 million to get back to cash and then reinvest those dollars at the new rate. So that is an unrealized loss. As things mature, they go back to par value and you are made whole on those dollars.
Okay.
But right now, if we were to sell the entire portfolio, we would take a loss of $8 million.
So that 8.2 million would be the cost of selling the portfolio because we're getting out early, and that's in essence
Because the rates are that
the
much
penalty
higher.
charge in essence is, okay.
But we could make a lot more than 8 million.
It kind of goes to the earlier question perhaps, so thank you. That's all, Mayor.
Thank you, Mayor. Just one question on page 14. You had mentioned that our portfolio had increased significantly over prior year. Were those funds, you said they were funds lying around. I believe that's what you said. What did you mean by that? And were they just surplus funds that had recently been acquired or had come into the city, or did you reevaluate all of our funds and determine that there were funds that could then be put into more of a long-term investment?
I'll leave that to you.
Mayor, Councilmember Melnar, so as revenues came in stronger over the last year or so, based on TPT, other revenue streams, that was cash that we hadn't budgeted for and therefore needed to invest for that time period. Additionally, we received about $60 million in ARPA funds that we hadn't planned on having, and so that increased the total amount of cash that we had on hand, and therefore we had to invest that money until such time that we needed it for city expenditures.
Okay, thank you. One follow-up question, if I may, Mayor. And maybe finance is a person to answer this. What amount of money do we not invest? In other words, what is our cash that we leave in liquidity and cash to meet everyday expenditures? Do we know about how much that is?
Mayor, council member, so typically we don't leave anything uninvested. So we either invest in the long-term portfolio or the short-term portfolio. Additionally, our cash is invested overnight through the bank so that we can earn interest on that money that we hold in our checking account, for lack of a better term. So that's an overnight investment through our banking relationship.
Okay, very good. Thank you.
No other questions? No other questions?
Thank you.
Thank you.
Okay. City Manager's report.
Mayor, members of council, just 3 quick items here. First of all, our community engagement process for our downtown campus reinvestment project is starting to take place. And so we're going to be hosting community stakeholders for this project. And so we want to make sure our residents know about this opportunity to come and to weigh in and learn more about the project, but more importantly, to be able to provide input and direction. So the meeting is going to be held on Wednesday, October 26th at 6 p.m. It will be held here in the council chambers at City Hall. Now, the stakeholders also can go online to our website, glendaleaz.com/DCRP, and that'll take you to an area where you can provide feedback and comments on the project. Again, we're started to load up the website information so that going forward, citizens can track the progress of what's there. So again, October 26th, 6 p.m. here at the council chambers will be our first of several planned community engagement meetings. We're also in the middle of doing a master plan update for one of our beloved parks, Saguaro Ranch Park, and so we're inviting the public to participate in this by providing their kind of thoughts on concepts and what they'd like to see at the park To date, we've already received 126 surveys, which actually is quite high for a park master plan, but we still have opportunity for the citizens to weigh in. We'll be taking feedback all the way up until October 16th. Of course, we'll get that information assembled, and then we'll be making sure we share that with the council when we've had a chance to get it all together. And then finally, would like to, I believe Ryan is here today, but would like to introduce our new fire chief for the city of Glendale, Ryan Freeberg. Ryan joined us starting yesterday. And he was 10 years serving as the Scottsdale fire chief. Scottsdale is the other Dale on the other side of the valley, if you guys aren't familiar with the city. And we're glad to have him here with the Glendale. And so again, please welcome, you're going to get an opportunity, welcome Ryan to the team. And that's my report.
Welcome. City Attorney's report.
No report, thank you.
Council items of special interest. Council has the ability to bring such items to the council that they'd like to have discussed by this council in a future workshop. Councilmember Clerk.
Nothing today, Mayor.
Councilmember Hugh.
Nothing, Mayor.
Councilmember Milner.
Nothing today.
Councilmember Tomachoff.
Oops, sorry. Yes, Mayor. Councilmember Milner and I had a discussion, and I'd like to have, I guess, a discussion on an addition to our sign ordinance on signs in the median. I know some cities allow them, some cities don't. We got, right now, a lot of signs in the median. And so I'd like to at least have a discussion on whether we think we want to continue allowing people to put political signs, open house signs, all kinds of stuff that we have stuck in our median, whether we want to make that adjustment. Thank you.
Councilmember Turner.
Thank you, Mayor. I have one. I think we need to have additional discussion regarding front yard parking, particularly as it relates to circle drives in our traditional residential neighborhoods. I'm having served on the code committee and know that being familiar with those conversations and also, of course, our workshops, and then seeing how it appears to be being implemented in the field, I'm not sure that we're all on the same page. So I think it needs to come back to us. Thank you.
Vice Mayor.
Nothing.
And I have nothing. We do have an executive session necessary. Could I get a motion?
So moved.
I have a motion from the Vice Mayor and a second from Councilmember Hugh. Any discussion? Hearing none, all in favor, vote aye.
Aye.
Do that again. Anyone want the executive session? Vote aye.
Aye.
Okay. Any opposed? Vote nay. Here's the ayes have it, do have it. This council meeting is recessed.